So, Symon, I know you've been a busy boy and you've been raising capital and building interesting developments. And I've been watching all of this go on for the last couple of years. And now you've got the developments coming out of the ground and super exciting stuff happening. And we're gonna be speaking about it. But besides being a busy boy, you've been having a lot of fun lately. What have you been up to?
Well, you know what? I think I deserve a lot of fun. I've been working my butt off for the last 3 years, quite frankly. So I got invited by our modular housing team company that we're working with to build our affordable housing, and they took us out on a helicopter from the Gold Coast Marina, which was great fun and a beautiful day yesterday. Took us to the Queensland Raceway, and we got into the V8 Camaros actually, and raced around the track. Did 5 laps. So I'd never done that before. Got all suited up. And I tell you what, I can see. Luckily, I had a party to tell me what to do because I had no idea. And once you get behind that wheel, put your foot on the pedal, you want to hold your foot on the pedal full speed, and you think you're going to make it around the track. And I'll guarantee you, on the first round, I would have wiped the car out if I hadn't had him telling me to stop, brake. I get brake. I'm like, okay.
So what are those? So you go flat out down the straight, and you can't see where the corners are coming.
Oh, you can see them, but you think you're going to get around without taking your foot off the pedal.
Oh, really? I hope
you've got no idea what a race car is like compared to a normal car. And, you're on these soft tyres on a soft track sort of thing. Yeah. So you have a tendency, maybe with me, I'm sure other people are the same. You have a tendency to want to go harder than what you should, especially when it's on your first and second lap. It's okay after you've done 5 or 6, but it was one hell of a lot of fun. They sounded so real. Like you felt like you're on a racetrack, racing a race car, which we were. You're all buckled up inside. You've got the roll gauge. There's a bunch of other people out there waiting for their turn. And 5 laps wasn't enough. I need bloody 50 laps.
Oh, well, I thought you were going to tell me that after 5 laps you were pretty exhausted, because I know I went for a drive once behind one of those cars years ago. And I think after doing about 2 laps, I was finished. I was absolutely exhausted, and it's a lot of power and energy that it takes, and it's quite strenuous. And that's probably why a lot of women don't become Formula One race drivers.
Yeah, like we were saying, I think, I don't know. Like I think the adrenaline fires up. So by the time you've done 5, honestly, I could have at least done 3 times that many laps, I think. But I haven't done it before, so maybe after 6 laps, I'm absolutely shot. But,
yeah.
It was a lot of fun. Getting the helicopter there, these guys were fantastic, and then took us to lunch afterwards. And honestly, I haven't done anything all year like that. We've just been working. So it was great to be invited to that and have some fun.
Well, if they ever invite you to do motorcycle racing, make sure you throw my name in the hat there, hey?
Well, you can do. I'll come and watch you because I'm not doing motorcycle racing. And you're on your own with that one. I'd rather have 4 wheels around me and a roll cage. Thank you.
I was brought up in a family with I started learning how to do motocross riding at the age of 9 years old. So I've had 2 wheels under my butt all my life.
Good on you. Yeah, good on you. I was brought up on a farm in New Zealand. I used to ride motocross bikes and stuff, and I can still ride a bike like that, no problem. But when you fall these days, I'm a bit older.
Yeah. Of course, yeah, you're going to be a little bit more risk averse. But anyway, having said that, let's jump straight in and get into the nuts and bolts of this is a little report that we've pulled out thanks to CoreLogic. I received their reports on a weekly basis. I just thought this was quite interesting, where they've put out the Home Value Index report, and it just goes through a couple of the more so. They do drill down into the suburbs, and if anybody would like a copy of that report, I'm happy to send it to them. But it's more looking at the states and the differences of the states and what's going on there. The interesting stuff, we're going to delve and dive into that, and we're going to be talking about the home index that's just come through from 2023. And the reason why I'm talking about the home index is because it has a knock-on effect into commercial. So whatever's happening in the market in residential creates a demand, or it creates the space for commercial in those areas, in and around those areas. So does that make sense?
Well, it creates a profile that's extrapolated across to the commercial market.
Yes. Yeah. So we were talking about speaking about commercial articles specifically, and I've chosen to have a look at the housing market over here because I think the housing market has got that effect on commercial. Wherever you've got growth in housing, you have demand in commercial.
Yeah, and also the housing market, Mish. And by the way, thanks for inviting me along. The housing market is a dynamic that tells us a lot about the economy, about what the global economy as well, even in some of these statistics, but certainly the local country economy. And that obviously has an effect on people's pockets and their investment choices in terms of where they want to invest, why they want to invest, and probably more than anything, when they want to invest.
Yeah, it does. And this is very interesting what they've put together here. This is a report from CoreLogic, which is one of the reports I do like to follow that pop these out fairly often. Sometimes it's a little bit of an aha moment. When I read these, I go, oh, okay, gee, that's interesting to know where the market is growing or shrinking, what's happening, how they see the future of where real estate is going, what's happening in the economy. And I think it's directly relative to housing, really.
Well, also, I think, if you look at some of these trends here, so if we look at the housing value index, it rose by 0.6% in November, marking the smallest monthly gain since February. Well, I don't think that'll be a surprise to anybody. There's obviously a lot of things going on. We had our interest rate rise in November, on the Melbourne Cup day, and that would have I felt in terms of being in business and being in the real estate development business, I definitely felt there was quite a dampening due to that happening, So, and I don't think anybody in this forum that is investing would disagree, and they would certainly know that last interest rate rise was like that little straw that broke the camel's back to a degree. It's obviously not sending us in a spiral, but it's definitely at a significant dampening, I think, in the marketplace. And that's also being reflected in some of the statistics coming from the stock market and the punters' views on whether we're going to have further interest rate rises or whether we've peaked.
I don't know, Symon, do you think it's a little bit of a knee-jerk reaction? I mean, yes, I know it has this last little increase on Melbourne Cup Day, as you say, it really was probably a bitter pill, despite the fact that everybody was out there drinking champagne and celebrating their horses. Wins or lose.
They've got to pay for their champagne as well, though, afterwards.
Well, they're going to pay for their champagne. It's going to cost 0.25% more. But yes, I kind of feel as if it was maybe, as you say, it's the straw that broke the camel's back, because we've most certainly seen a little bit of a pullback in the market and people just being very careful about their spend as a result of that. Yeah. But the statistics are still pretty interesting because despite the fact that you have that pullback, you've still got incredible growth.
Well, we've had incredible growth slowing, and that's the important factor here. It only rose by that 0.6% in November. I mean, if you look at the bottom part of this piece here, this slide, you'll see 8.3% higher over the past 10 months. I think we were down about 7.5%. It might be in one of the other slides going forward, but we're slightly above where we were in February. Not there, that's more the local stuff.
Yes.
But we're slightly above where we started at the year, I suppose, but not much. And that's not surprising. We've got a number of things happening. We've got interest rates rising. We've got inflation still too high, although coming down and slightly lower than what the expectation was in the recent data, which was good. It's certainly positive, going in the right direction, but probably not fast enough. And then you've got other issues like government expenditure and proposed project expenditure and believe it or not, a tight labour market in terms of qualified skills. That's a major issue. I talk to all types of people in the industry, and if you've got Melbourne and Hobart showing a decline, growth in Sydney slowed, smallest monthly gain in the recovery cycle. This is deemed to be the recovery cycle, and may follow Melbourne's lead, dipping or stabilising.
Yeah, I mean, it's interesting. We all know that Melbourne's taken a little bit of a slippery slide ever since COVID. It hasn't really kind of bounced back as much as the other cities have. We've seen a little bit of a bite upwards in Hobart. and Tasmania. I don't know if you've experienced that.
Well, I haven't been focused on the Tasmanian market, to be frank. I mean, I'm quite centred in Queensland, although we have business partners that are in New South Wales doing a lot of development.
Yeah.
And we're in the affordable housing space, as you know, primarily. So that's a commercial asset class, but as we were talking about earlier today, it's a niche commercial asset class.
It is quite a niche commercial asset class. Let's have a quick chat about that in the conversation that we were having earlier about it being a niche commercial asset class. It's a little bit like storage or like a house of multiple occupants. In a broader sense, you're looking at multi-tenanted, an asset that has got multi-tenanted. So your risks are mitigated by the fact that if you lose one or two tenants over here, you've still got good income that's coming in.
Well, I mean, dear to my heart, affordable housing, only for a number of reasons, beside the fact that it's a good asset class to be involved in. It's exciting times because the country's in desperate and dire needs for affordable housing everywhere, including the rural areas. And our view is that we can help solve the problem, and that's what we've set out to do. We've got half a dozen good projects around Queensland, and just found some significant venture partners that have now come in with ex-Stockland's pedigree. So it's pretty exciting, and they've got quite a bit of capital to invest, and they're keen. And we're talking to funds managers, and there's just a lot more impetus in that market. And we saw this coming 3 or 4 years ago. So we started to acquire real estate back then, and it's showing up that we've made the right decision. So timing has a lot to do with it, but also I really want to see us do something worthwhile in the community, and that triple bottom line that we're really centered on, social, economic, and financial, environmental benefits, social, economic, and environmental benefits is what that's about. And affordable housing sits right in the pocket. And yes, like we were saying before, I mean, it is being seen from the valuation community, from the build-to-rent community, and from the larger scale developer and investors globally. It is actually a commercial asset class, a niche commercial asset class. And
let's just break that up a little bit. It is residential. So how does it get from residential to commercial? I know it's got commercial lending. Let's just dissect that a little bit.
Well, that's a good question, and I'll happily answer. So in short, you're talking about scale. So when you talk about residential housing, and a lot of your investors here, or people that are getting into commercial or own commercial, most likely started owning a rental house. So that's your typical residential rental property. The net return on those things is 1 to 2%, probably, if you're lucky, 3% net return. When you're talking about build to rent, you're talking scale type development. So you're talking, at least 50, 100, 200, 300, 400 apartments or units, or combinations of things and buildings and what have you. So you're talking a commercial scale type development and commercial scale type investment. The little mum and dad thing doesn't interest those types of players because they have billions of dollars worth of funds, superannuation funds, international superannuation funds, sovereign wealth funds. So that sets it apart because of the scale. So number one, scale. Number two, it's managed commercially and professionally. So again, it's not some real estate agent locally that goes and rents out your room. It's actually a professional management structure, and it's managed in terms of the cost of that structure, the furniture, the power supply. Everything's done on a commercial type of aspect.
So if we were to have and I'm having a think here of the difference between what you're manufacturing, what you're busy developing at the moment, and for old time's sake, a block of flats. Let's just take a block of flats that has maybe got 20 flats in it, 1-bedroom flats, for instance. Now, I actually bought quite a couple of these, and they were great little assets, although in those years, we ran them very differently. So what's the difference between owning a block of flats and doing what you are doing?
Well, the difference in terms of how they're treated is not that much. So when you are a valuation person and you come along and value a block of flats, you actually value them based on a cap rate, which is commercially valued. So that one is virtually the same. The difference is generally a block of flats compared to a build to rent. Actually, really it is the same technically, but they generally have been done in much smaller scale. So, you have 6-packs, 12-packs. I owned a lot of them as well and renovated a lot, straight up, titled them, sold them off in New Zealand as well as over here actually for other investors as a consultant. And technically they're no different, but the quality of the asset today is very different. So in terms of the construction methodologies, the type of construction, you're talking about heating and cooling, how that's managed today, the efficiency, energy efficiency ratings today are quite different. The fire codes quite strong, much stronger than what it used to be. And those old places have to have that upgrade generally, and that's, it's expensive.
Yeah.
So you're talking really about a modernized version of that, of a boarding house, if you like.
And it's also, I think, if anything, if I have a look at what we had in the past and what you guys are busy putting together, it's optimizing space. It's a little bit like comparing buying a car in the 80s versus purchasing a car today, a motor vehicle. I mean, today...
Another big thing is how they're run. So back in those days, if you've got small scale, you can't afford to have on-site management. You can't afford to run them well, effectively. It's usually your local real estate agent that runs it for you.
Yes.
Yeah, I'm not putting local real estate agents down. They do a fantastic service to the community, no question about it, right? I've dealt with them all my life. Yeah. But if you're running 100 units, it's not going to be some local real estate agent that will run that 100 units. It's going to be a professional management organisation that's structured and only do that. They're not selling something, they just actually manage a building.
So the management company that you're using would be a commercial specialist and specializing in this type of asset class, right?
Exactly right. And that's really important.
Yeah. So it kind of narrows it down a little bit. If we've got an audience out there that's busy listening to this and they want to build some of these and have these for themselves, how would they go about it?
Well, I mean, a lot of people do these little 5-room type rooming accommodation houses. So if you want to do something at that level, you can do those. Depending on the council that you're in, they will change. That's what Brisbane allows. Sydney's opening up the doors massively to allow for an increase in density in the R2, 3 zones and around train stations. New South Wales is going to be a humongous opportunity. But, trying to swallow it and get the volume going is going to be hard. But what do they do? They go, well, they can come along and invest in companies that do it, I suppose. Some of these larger organisations. But generally, these larger organisations like the Mirvacs and Stocklands of the world and those big companies that are doing them, they go to really large funds and they get really large lumps of money. So there's actually nearly nobody doing it at the level where we're sort of at that level below the big guys. We're minimum 50 up to 250 rooms, if you like.
So, yeah.
So small investors can get involved that way because we're not going to the big super funds yet. We will one day sell more than that.
The project that we're looking at the moment is 72 units on 2,000 square meters. So, and it's in 3 different blocks. So it's quite impressive. It's quite different. And as you say, it's not quite as big as what the Stocklands and the big guys are doing. But it's that leap ahead, and what you're basically doing is you're filling that gap between the 4 and 5 sort of bedroom housing accommodation versus the huge apartments.
Well, that's correct. And the other really big benefit that we're able to do is because we're a small, nimble organisation, we don't have a lot of big overheads and mouths to feed. We do it with a small team of half a dozen people, and we're able to get it down to a scale that allows us to get our cost base down. So what that really means is that we can sell affordable living. That's a big difference between the build to rent model that most of the big players, in fact, all of the big players are doing. Governments and councils and local bodies, people want to see affordability for service workers, single mums, all that sort of thing. And that is the biggest, it's the bottom of the triangle.
Yeah. So you're doing this in Brisbane right now, and we all know that there's a huge demand in Brisbane. We're having a look at regional variances. For instance, Perth. Perth has just grown exponentially, and I think is probably recording the hugest gain of 1.9% since March 2021. Brisbane 1.3%, so it's lagging behind Perth. And Adelaide 1.2%. So what you're doing at the moment, do you see that as bridging the gap, plugging the hole? Do you think Perth is going to have the same sort of requirement, Adelaide going to have the same sort of requirement because of the growth?
Well, I don't think they have. I think I know they need it. There's so much data out there, and I'm involved in so many different groups where I communicate with people and we see stuff all the time. There's need everywhere. So these numbers on the screen here, the Perth, for example, that's your growth and values. the reason that's at 1.9% as opposed to Brisbane and Adelaide, it's sort of further down the property clock. So everyone here knows about property clocks, and it's on the recovery side of the property clock. It's the marketplace that investors are running to at the moment, because that's the next part of the cycle in Perth, because as we know, it goes sort of around the country. So Perth's getting the growth right now, right? Anyone that bought in Perth a year ago is probably quite happy. Brisbane got some growth on it as well, and Adelaide a bit here too. So they're just the different parts of the property clock.
Yep. See.
Different parts of the property clock. So all of that has an impact on where people want to invest. But this is all about housing, and what we're doing obviously in the Southeast Queensland sector of the market for now, and we'll continue to do it in every one of the other cities, is a model of providing, a commercial residential rental structure.
Okay. So, I know you are looking at maybe moving into Sydney at a later stage, and you've got a couple of projects on in Brisbane. I've just popped up sort of what the home value index is currently, and very interesting figures, because Sydney is at 0.3%. Melbourne is negative at 0.1%. Brisbane is, again, pretty high, 1.30%, Adelaide 1.2%, Perth 1.9%, Hobart negative, Darwin negative, Canberra 0.5%, combined capitals. So that would be all your capital cities that is sitting at 6%. Combined regionals, the same.
Yeah, that's right. That was part of the commentary. They're saying that the rural or the country regions are pretty much coming in line with the city regions, and in fact the growth is about the same. When you take it from a national perspective.
Yeah. So it has been national. I mean, nationally they're looking at 0.6% as in November. So it was the end of November that this was.
Combined capitals and you combine regionals are equal to the national. So it's 0.6, 0.6, and 0.6 across the board.
It's actually interesting, because I would have expected that regional would have been slower.
Regional is slower. So what's happened is that the combined, or the capitals, have slowed down, moving towards the regional growth. Okay, so regionals are slower, have been slower. There are times when they haven't been, but in general they lag the city counterparts. And in this current situation, the capitals have actually slowed down, and they're moving towards place.
So you think the capitals have slowed down because of the post-COVID thing?
No. It's all got to do with interest rates and supply. So the reason we've still got some growth is that there's a real shortage of supply. And one of the reasons why there's a real shortage of supply is that we've got the reason we've got a real shortage of supply. So we're just talking about the regional versus capitals, and the regional sector is pretty steady. The capitals have slowed, and that's why the regional rate is similar to the capitals rate at 0.6%.
So why do you think the capitals have slowed? Are you saying that the capitals have slowed because of the interest rate, or less demand in the office space? Because I'm actually seeing it going the opposite direction. I'm actually seeing office space starting to come back.
Well, the economy is still growing. We're just over 2.2% GDP for the year. So we've still got growth. There's still business occurring. People still need floor space, even though the COVID thing did have a serious impact on the office space. But there's always demand for new office space if it's right, and if the supply-demand equation is right. You're probably seeing a bit of a balancing up. I haven't seen the statistics lately, but that's probably what's going on there, why commercial is becoming a bit more interesting. I haven't really seen, and we're in industrial as well, I haven't really seen industrial decompress a lot. It has a little, but not a lot. And I don't think you're going to, because, and this is what you're trying to do as a property investor and developer, trying to work out where you think it's going, and you're never going to always get it right. But it looks to me very, very like we still have very high immigration, which is making an impact on the residential supply-demand equation. We've got construction prices that have significantly increased over the last 2 years. So it's quite expensive to build. Land prices are still being held high. No one's under a lot of pressure yet. And I don't think they'll get under a lot of pressure, because I don't think you're going to see interest rate rising. If interest rates continue to rise the way they have been in the last 18 months, 2 years, that's a problem. Okay. But if you read the data here and you read what the Reserve Bank is saying and what the punters are saying and the commentators, most likely we aren't going to get a significant increase in rates, but we might have rates sort of around this region for another 12 months or so. Now that keeps the pressure on the economy. It keeps the lid on things, but it doesn't stop the economy moving and growing and people needing jobs and building buildings. And, people that are building logistics centers, and there's a lot of that going on. The large players are holding and building those things. They're growing. They're actually doing more. There's data centers, the data centers are absolute huge demand for those. So there are sectors that are growing faster than others, but industrial is still pretty strong. It's still a darling.
Oh, I think industrial, I would agree with you over there. I mean, industrial, I don't think you can pop industrial out fast enough. And you would know, you're developing industrial at the moment, and they just, you said
there's a lot of demand. The issue is trying to build them and get them out the door at the right price. And so the valuations haven't really kept up with what you need to sell something for. By the time you build it, buy the land, there's not a lot of margin in it for a developer. So that's why there's not so much of it happening. It's not because there's no demand. It's because you just can't get it valued at the right rate. You can't sell it at the right rate to make enough margin to take the risk and do it.
What about land release for industrial? I mean, I'm aware of some green lands released in residential. And personally, from my perspective, I don't think they've released enough or made enough capacity for commercial in and around those areas.
Well, that's another major discussion, because that's been one of the biggest issues in this country in terms of how we've developed our subdivisions and our greenfields developments. Yeah. Everything's sort of concentric into one area, and everyone's got to drive everywhere. The infrastructure can't really keep up with it. We don't have enough public transport. All of that's we're going to have decades of that problem to solve, which is great for people like us who love going out and solving problems, and that's how we make our money. And it's how your investors make money, by picking the right thing at the right time in the right location. It's all of those factors, and we're going to see some real change. I mean, if you look at the politics at the moment around every state, there's a lot of concern about people being able to afford to live close to their work, and that's why we're so excited about, providing affordable housing, is because it's an untapped market.
I think it's not only living close to where you work, which of course is a bonus, but living close to, as you mentioned earlier, infrastructures, transport systems. And I know that, or let me ask you, I mean, a lot of the developments that you're busy looking at or building at the moment, is that one of the criteria that you look for?
Absolutely. Like if we can be close to infrastructure, obviously that's one of the key things we look for. I mean, but any investor should be looking for that, whether you're investing in any product.
Symon, what are the criteria that you look for when purchasing property in order to build these, let's call it co-living spaces?
Yeah, affordable housing. Look, it's actually quite tricky. And the reason it's tricky, we've got to find land that is zoned well for what we want to do. So we get enough scale on a small house block, if you like, or something a bit bigger than that. Like the ones we've got at the moment are 2,000 square meters, and we're doing an amazing amount of product on such a small space. Then you've got your car parking ratios to get considered, because if you have to go underground, you can't afford to build affordable housing. That's another major problem. That's why we sort of have the market to ourselves, because we think we've cracked that, and most people haven't, and they're not looking at it because it's too hard. And that's why we spent 3 years on it, because we figured if we could crack that, we'll have the place to ourselves. And not that we want to, because we actually want everyone to be doing it, but if we've got to crack a model. And the parking ratios, there's a major. I was invited to the Gold Coast Mayor Roundtable group recently to look at some of the problems on the Gold Coast and see if other developers and other investment groups can help find a solution, which I was absolutely thrilled to be part of. And I went on and on and on, and got had up about it, because I kept on talking about car parking ratios, because as a developer, they're actually what limit your projects, and getting a lot of money building them, and people have got to pay for that.
Yeah, and I know from just purchasing properties all the way from Sunshine Coast all the way down to Gold Coast. I mean, it's always one of the biggest concerns when we were talking about industrial properties. Popping a mezzanine into an industrial property is all very good and well, and yes, you can do it, and good luck trying to get council certification on that, because the first thing they're going to ask you is, how many car parks do you have? And that's,
Absolutely.
90,
Absolutely.
90% of those warehouses are not certified purely because of parking.
That's right. Well, it's just such a major hurdle, and I don't think people are really switched onto it. But I've been doing this for over 35 years, and every project is really set about by how much car parking do you have to build. So to take that back to where we were, to create affordable housing, we need to build at the right price, and we can't afford to build more car parks than we need to build. And I know in some places, in New Zealand, for example, some councils have totally eliminated car parking where there's good infrastructure. So going back to infrastructure, public transport, you need to have all of that available so someone doesn't actually need a car to get around other than the occasion. Then you've got Uber and you've got ride shares, and in Sydney, you've got Go Get, where you just walk down the street and grab a car. I was a member of that. We need more of that, but we need a lot better public transport and a lot more of it. And that's going to take 50 years plus to solve, really.
Yeah, of course, if not longer. But so, from a residential point of view, yes, I could see that is most definitely creating a demand on lower prices or more affordable housing, affordable prices. And yeah, I mean, we're doing that cross-pollination between that and commercial and pulling it into the commercial sector. So niche
commercial market. Yeah, what we're doing is a niche commercial market. I need to make that point because, it is a commercial asset for all the reasons we talked about earlier.
Yes. Yeah, we don't need to repeat that. It is commercial lending and all of that. So where to from here?
Yeah, good question. So, they're below them, the May 2022 historic high, but we're only just below it. 1.8% is nothing. Like if you're looking at, when you buy real estate, you buy it for, you should really be buying it for decades, not for a year or two. So 1.8% up neither here nor there. So basically, we're on a high. Now you got to ask yourself, interest rates are at a peak. How the heck can we be at a high in values? Well, that's very simple, in my opinion. It's a supply and demand situation. Builders can't afford to build at the rates that they need to build to make the sales and the economy's still there for it. Land's high, so it just doesn't stack up. So we're just not getting as much supply there. And then you've got councils and all the different red tape you've got to deal with trying to get approvals. And if you're not making enough margin, you can't bank it. I mean, I talk to these people. I'm part of the community, so if you can't bank it, you haven't got a project. Simple as that. Lenders are nervous because they know that interest rates are high and that there's going to be failures, and there will be. There'll be people that are holding on to land that can't get them off the ground. I hear about it every day. Can't get their project off the ground. You can only sit on a piece of dirt that owes you a few $1 million for a period of time, and eventually, the chickens come home to roost. Or else you're putting up somewhere.
Do you see quite a lot of that coming back onto the market, and it's being an opportunity for those who have been sitting and waiting for this bubble to burst? I almost want to say that this is an opportunity to get in, and as Warren Buffett says, be bold when others are scared, and this is moving into a scared market. And be scared when others are bold. So we've been through our bold cycle. Now we're going through the fearful cycle where everybody's saying, oh, interest rates rising, getting too expensive. And of course, a lot of people came off fixed interest rates, most certainly in commercial. They came off fixed interest rates at like 2%, 2.2%. And the interest rates have just got boom, right up to 6-7% and climbing. So it's kind of created a little bit of a supply back into the market, I want to say. Commercially, I'm seeing that supply back into the market.
Yeah, I mean, I'm talking about more the development stock. I think it's still very tight, and goods development stock will remain tight. Anything that's sort of secondary will, less than that's going to have a little bit more loosening, and there'll be more problems in that area. But I think overall, the market is still pretty good and pretty strong. And I think basically at the end of the day, when there's fear in the streets, like you've just said, there's a level of that. It's not real fear, but there's a level of uneasiness, I would say, is probably a better word. People with money are the ones that are going to win. So being cashed up is the key.
So even if people want to get involved in the projects that you're doing, I mean, we've been speaking about it quite a bit now. It's a little bit like armchair investing, where they can get involved. They can have a look at how you're putting this together as a commercial asset. and be tipping in a little bit of cash, be sitting back and watching their money grow effectively. Because what you're doing, I mean, we were talking about the gains that or the savings that you've managed to make on this project, and you're giving back to the investors. So
we're giving good returns, and I think investors make good returns in the development game.
Yeah.
What I think the opportunity for your probably for a lot of people that you speak to, Mish, is that there's a lot of smaller commercial investors, and the problem they've got is getting into I'm saying a commercial factory or an asset or whatever, but you can't really buy much for under $500,000, and there's so many buyers under $1 million. Everything is hotly sought after. That's why the rates are always really tight at that level. I mean, how do you get yourself started if you've got some money, but so I think the opportunity for those type of investors is coming into a pooled fund type scenario where they come in and basically participate in a project, make returns, get involved in the business of property, getting involved, putting your foot in. It's another level above just owning a residential rental property. It's just that next level. And plenty of people are ready to take the leap, but they still don't really have enough capital probably to do it.
Yeah. And we've actually got a couple of our clients that has done that. They've purchased commercial real estate, their own commercials, and then they've joined us on a couple of ventures where they've put their own cash into it or their equity, and a lot of those projects have paid them off, and they've actually pulled their equity out already with good returns. I can't remember what the numbers were off the top of my head, but I think they were close to about 12% in the one case. This one in particular that we're talking about is 20%, and that would be between 12 and 36 months. So that's pretty good returns commercially if the interest rates are biting at the moment. It's a good place.
Well, I think if you're an investor and you're buying commercial, and I've buying tons of commercial stuff over the zone, 11, 12-story buildings and all sorts of industrial. Everyone's doing different things at different stages in life. I just want less of anything these days. I just want to get out and do things and less of having to look after things afterwards, So keener on building a huge pipeline of development opportunities and having fun to buy them at the end of each project, which is what we're working towards.
Yeah.
But if you're an investor, what do you do with your $1 or $2 or $3 or $500,000 that's worthwhile for your time and effort and energy and risk and all the rest of it? You don't get much of a commercial property really with that sort of money. How do you get involved and stay involved in it? And then the question is, why are you doing it anyway? Like most people just want to make a good return. So there's a bunch of ways to make returns. You can make it from money in the bank at 1 or 2%, up to high risk investments in cryptocurrency where it can go down up and down 80% in a day. I mean, and there's nothing wrong with those, by the way. It's just different, right?
If you understand
you can invest in the stock market, and actually, I watch a lot of really interesting stuff, and really interesting people, macro investors that manage billions and billions of dollars.
Yeah.
And when I looked at the graph just yesterday, the only things that actually get above inflation, in terms of American inflation, is REITs, real estate investment trusts, and one other asset class, and everything else.
And
share market.
Very, very heavily weighted towards commercial real estate, I'll have you know. The REITs.
It's all commercial. The REITs are all commercial. They're not residential.
Yeah.
They might have a mix of what we're doing. There could be some REITs in that space in America. There will be, because it's quite a large asset class over there. But in terms of the total asset class, it's tiny, So that's the only place where people are getting north of, a couple of percent over the inflation rate.
Mm.
See, it's so important to understand that your money's going backwards at 5% a year in this country. Your buying power's going backwards. At least you're getting 5%. You're not even keeping up with inflation.
Yeah. Well, if you're putting your money into assets, I always say having money sitting in the bank is not, if it's not working for you, then you might as well just be burning it. Seriously. So, the whole purpose of money is working it so that it's working for you. And I'm looking at
you have to work it, because if you don't, you're actually losing. Even if it's in the bank at 2%, you're losing 3% if inflation's 5%. You're going backwards.
Totally agree. So, Simon, the difference between putting your money into, let's say, a 7% yielding property at the moment, and your interest rates are close to about 6.8%, versus putting a chunk of cash into developments. I mean, you're talking about development properties. So if you're investing in your developments that you're busy doing at the moment, you really are it's development capital, it's development equity, and you're earning development, call it dividends, effectively.
Yeah, well, you're earning equity type returns.
Yes.
If it's equity, it is a level of equity risk, right? You're not got a first mortgage, so you've got equity. So then you earn the returns of an equity investor, and that's got to be, they start at 12 and go up to 30%. Not our projects; ours are all around that 20% mark. But that's what I think. If you're not earning that and you're getting involved in this game, and you shouldn't be in it. I've said that before.
Yeah.
So I think that, and you sort of need to understand what you're doing.
Yeah.
And you need to put only a portion of your money in, and you need to know that you're getting the right return for the risk taken.
Have you seen any 30% returns in the last 12 to 24 months? I
haven't been offering them. I know that we did that commercial thing back 3 years ago, and that made our investors probably 30%. That was exceptional. Realistically, I think if you're around that 20% mark, it's realistic.
Yeah. I would agree with you. I think the market has shifted quite substantially, and that was sort of when the market was running scared that we did that project that gave 30%. I haven't seen that for quite some time, and with my sleeves rolled up on a daily basis, looking, hunting, searching for those all the time.
Well, and I sort of haven't been, because I've got a couple of industrial things. They're more man cave types things, but this new partnership that we've got with this group out of Sydney is very strong, and they're basically taking half of every project now. So it's a beautiful deal for us because they've got corporate credentials in terms of being developers, and we've got our on the ground credentials as well and tons of experience. So added with them, we could do 30 or 40 projects at a time now, and plus they've got their own capital on top. So I feel so good about that and that's why I wanted them in. We've given quite a bit away to get them in, because when an investor comes to us now, we're able to say, well, by the way, the smartest money in the game is also with us, because these guys also know the game. They're also doing their own projects, and I'm probably got $500 million worth. They probably have. I don't know for sure, but they've got a lot, land and residential communities. They understand what we're doing. They're really keen on what we're doing. They can see the opportunities. They can see we've brought good things to the table. They want a piece of it, and so now when an investor comes in, I can put my hand on my heart and say, well, don't just listen to us, listen to these guys who have also come from that, that Stockman's type pedigree or that corporate pedigree. They have their own money on the table at risk, as well as us and anyone else that joins us. All of a sudden, that story's a lot stronger, and I think it's just better for everybody, more certainty what you want to try and achieve.
Okay, so we've kind of gone down a different rabbit hole, as we always do over here, because we're meant to be talking about market sentiments and sort of projections of what's going to be happening in the new year. But I want to ask you a quick question, and that is, you've got these heavyweight developers and investors that are coming on board with you. Why would you be offering a percentage to equity investors?
Well, we've got to bring our equity. We've only got it. We're not as big as these guys, so they've got all their own cash. They're a couple of wealthy families out of Sydney. We've got some money, but we don't have enough to do the scale that we want. We want to get it to $1 billion pipeline. Takes a lot of money, so they may not have enough money to do that either. So there's a chance that we'll get to a point where we'll all need to go be raising more capital.
So the incentive for people that are listening right now to come on board would be what?
Well, the incentive for anybody that's interested in what we're doing is a commercial. If you're thinking like you want to own commercial property, well, here's a piece of commercial opportunity in the commercial property space in a niche sector that's got the highest demand in the country for any type of residential accommodation. Nobody else is achieving the sort of returns that we're able to achieve because we've found innovative ways of producing those returns through construction design, town planning and zoning and car parking arrangements. It's like finding a needle in a haystack. So that's what we're doing, and we think we can scale that. Governments are now starting to get on board and to getting their heads around the fact they need to change zonings that allow more flexibility in their design. And I'm involved in a number of groups and pushing and communicating the same message over and over and over till the politicians start listening. And everybody knows that, when you go to cafes and they can't find staff. Well, there's a good reason for that. It's not because people don't want to work. They actually can't live close to where they need to work. And that's the problem. Every big business that's made money and started small, like we are, have made it because they solved the major problem. We're intending to solve that major problem.
And bingo, Symon, that is it. It's niche market, and you said it. This is an opportunity to get into that niche market and get a piece of doing something different, something new, something novel. I mean, I know the architecture is very new. You've been using Gensler, that are the biggest architectural firm worldwide with 53 branches all over the world. So this is it's basically breaking the mold. I mean, you guys have come up with an amazing opportunity, an amazing product, really. And I'm super excited that it's a commercial product. So, whoop, whoop.
Yeah.
Let's earn 20% per annum.
Well, show me what's better. I mean, at the end of the day, anybody that's sort of semi-retired or retired or wants their money to work, that's a good return. And you're in a market, if you're taking a risk, you're in a market that there's unlimited demand. And it's probably going to be like that for 2 decades or more. No one can actually physically build as many houses as we need. The government can put out these $10 billion plans and all the rest of it and get all the zoning right. Someone's still got to supply the labour. Where's that all going to come from? There's less and less and less tradies around. They're more and more expensive, and they've never been that reliable anyway. In my view, that's quite a broad opinion, but I've dealt with them all my life. But there are some very good ones that don't get me wrong. But what I mean is that, the supply side is constrained. Even if all the planning let you do whatever you like, you're still going to build them.
Well, you tell me, who's going to build yours?
Well, we've got modular housing. So we're actually designing everything to take modular housing. So we can get standard construction and modular. Now, we're looking at a project at the moment up to Toowoomba. Standard design, construction, 12 months, modular, 3 to 4.
Wow. Okay. And that's
called velocity of delivery. Not only that, Mish, they can build it 24 hours a day in the factory and ship it out to the site.
Another bingo. Another box.
I had lunch with them yesterday. That was really exciting. All of us are sitting there going, it's just the right time for it. All of us we're doing today. I'm super excited about it, actually.
Well, I'm super excited about it as well, because you and I have had a multitude of debates over the years, and I've always come in from the commercial aspect. You've always come in from the affordable housing space, and I'm now looking at it and I'm saying, yep, actually, it is far more of a commercial investment now that we look at it through these lenses. And I'm loving the modular, the modular builds that you're showing. So I think with that said, we know where the markets are. And just to end it off, would you agree that despite the fact through all these numbers and statistics that we look at, essentially, I think all of these markets are just set to grow, no matter what state you're in. I mean, they have their ups and downs, their ebbs and flows, but I think all in all, there's growth all around us.
There is. It's just a matter of the pace and the risk you're taking to get the growth, how long it's going to take, and how high is interest going to be for how long. No one's got a crystal ball. Yeah. But we do know that the government is spending on infrastructure, the federal and state governments. That even though that's been dropped back a bit, it's still a major amount of cost to swallow and amount of supply to swallow. So that's going to keep things pretty tight. It's going to keep costs high, prices are going to be high, interest rates are high. So it is a time for softness in terms of the supply side. And that's still going to hold the problem of affordable housing, coming back to what we're doing. I can't see that changing in a decade or more.
No, I can't see it either. But yeah, I mean, it is what it is, and I think you're solving the problem. So, if people want to get involved, they can contact us at revolvecommercial.com.au and reach out if you'd like to know more about what Symon's doing right now and how you can earn good percentages, good returns per annum. Reach out and we'll be happy to share the information with you and get on board, find out about all the new stuff.
Thanks for having me on, Mish. I know we wandered a bit into our territory. That wasn't the intention, but anyway, good thing is it's all relevant and it's all resources for people to think about. It's not just, there's plenty of people that talk about commercial this and residential that, but this is an interesting niche market that I think is, it marries commercial with the residential desire and need.
Symon, I think you and I are always having very interesting debates. We're always having very interesting conversations. And, just having a look at, where market is, I've been watching you guys do what you do, sort of from the outside, and getting involved here and there where we can. I think it's a very exciting space to be in right now. You know,
It is.
if you're in real estate with the pressure that's on, and I would say nationally, the pressure that's on nationally, you're set to make good returns.
Yeah, we're going to get a lot of support. We're already starting to get it. Once we get these guys embedded in their business, they've got a lot of great connections as well, and church groups and what have you, and some significant ones I can't mention. But, you know, it's virtually unlimited. The amount of opportunity we're going to be able to supply to investment market, to the people that want to own them, you know, to the tenants that live in them, it's unlimited.
Yep, I would agree. Absolutely.